So there has been a lot of talk in the past few weeks about recession warnings, whether it is record low interest rates or that yield curve inversion, and now a decline in spending by wealthy consumers, as Robert just mentioned. So how reliable are those indicators? Is a recession on the horizon or not? We have two opinions on that right now. Bill Lee joins us, Chief Economist at the Milken Institute. He says he does not believe a recession is coming. And David Sowerby, portfolio manager with Ancora Advisers, says he sees a recession hitting the U.S. sometime late next year. Gentlemen, welcome.
Thank you, Sue.
Thanks for having us.
Bill, I'm going to start with you. You actually see the yield curve inversion as a bullish sign. How so?
You know, every time the yield curve is inverted in the past, it's because the Fed's been driving up rates to try to slow the economy down. This time, the yield curve is inverting because a lot of money from around the world is coming to the United States because the United States is where the highest returns are because capital can be used most productively here. And as a bullish sign is that everyone is coming here because this is where the growth is, this is where the profits are, and this is where all the returns are going to be.
David, what say you? What are you looking at that says maybe a recession next year sometime?
Bill, two quick points. One, we have not solved the business cycle. We will get recessions. Second, I believe in the yield curve. And when you look at it the way I do, short-term rates, Fed funds rates, 2.1%, the 10-year Treasury at 1.5%. Yes, the 10-year Treasury has come down, but Fed funds have gone up from the zero level. We've had the equivalent with higher Fed funds and Fed reducing its balance sheet by anywhere from a 300 to 350 basis point hike in the underlying Fed funds rate from the low point, including the balance sheet reduction, inverted yield curve, 9 out of 10 times. It's got a great batting average. It gives us a recession. We simply don't know exactly when, but I think it's within a year to maybe a year and a half.
Bill, over to you now. You know, the economic data does in general look strong, but we are seeing slowing in the manufacturing sector. Some say that manufacturing is in a recession. And as Frank just reported, the wealthier consumer is starting to kind of pull back a little bit. Yeah. Wouldn't that slow the economy?
Absolutely. In fact, we have a global slowdown going on. The question is, will this translate into a metastasized slowdown in the United States? And right now, the thing that holds it back is the consumer. And Robert's report is showing that even the upper-end consumers are starting to feel what economists call the wealth effect. The stock market volatility is causing wealthy individuals to say, I may not be as wealthy as much as I thought, and I better start saving more. But now, will that then translate into labor markets where companies start to lay off people, they start to cut back on hours? If that happens, truly you will get a slowdown in the United States and possibly a recession. But so far, we have not seen any evidence that the regular man who working stiff, who is going to work every day, is going to have a layoff ahead of him in the next 6 months to a year.
David, we should point out, you're not talking about a financial crisis like we saw 10 years ago.
Heavens, no.
What kind of a recession would you see this time around?
Well, I'm a portfolio manager first and foremost. People never forecast dire recessions as we saw in 2008, Bill. So maybe on a 1 to 10 scale, it's about a 6. Where I get worried is in the corporate sector. I think debt levels have started to get too high. At the public sector level, even higher than that. The consumer's in very good shape. Consumer free cash flow is very healthy. So at the end of the day, it's about a mild average recession with the key being we never know exactly what the risk is that's going to create one, but I think we haven't solved the business cycle, and we're going to get one.
All right, gentlemen, we'll leave it there, and we'll see what the Fed does coming up in September. Have this discussion once again.
Thank you, Sue.
Thanks for having
William
us.
Lee with the Milken Institute, David Sowerby with Ancora Advisers.